Okay, what I have for you in this video is not for the faint of heart. What we're going to do is derive the cash flow statement using the balance sheet. This is not something I'm going to ask you to do on an exam, but it is something if you pay careful attention, it might kind of open up your knowledge of how financial statements are connected and how cash flows in particular are connected to the balance sheet through accruals, through the accrual process. And so let me share my screen and I'm going to disappear on this one. Okay, so on this slide, I've got assets, liabilities, and equity, and assets equals liabilities plus equity. And so this blue line here that goes horizontally represents equals. And I'll use my laser pointer. So this blue line represents equals. So whatever is above the blue line equals whatever is below the blue line. So we'll start with the knowledge that assets equals liabilities plus equity. And the next step in this process is to agree with each other that we can add a delta in front of each of these terms. And so delta, which is just this triangle symbol, means the change. And so what this next expression is saying is that the change in assets equals the change in liabilities plus the change in equity. And in mathematical terms, it's kind of like taking a derivative, okay? But this is true. So if you think that assets equals liabilities plus equity, it must also be true that the change in assets equals the change in liabilities plus the change in equity. And the reason is that assets have to equal liabilities plus equity at the beginning of the period and at the end of the period. So if you were to kind of work that through in your mind, you'd be able to convince yourself that the change in assets must equal the change in liabilities plus the change in equity, okay? So that's step one. Step two, we're going to break out this change in assets, okay? We're going to break it out into the change in cash, the change in accounts receivable, the change in inventory, and the change in PP&E. And I'm just simplifying. You could have all the different asset accounts here, but I'm just simplifying to 4 different asset accounts just so I can fit it on the slide. So what I'm doing is I'm breaking the change in assets into the change in the 4 components of assets. Okay, so that should be pretty comfortable for everybody. Then in the bottom of the line, for liabilities, I'll split liabilities into 2 parts. The change in accounts payable, which is kind of an operating liability, and the change in debt, which is a financing liability. And by the way, PP&E here, that's an investing asset, whereas inventory, accounts receivable, and cash are operating assets. Okay, and then finally, that change in equity, what are we going to split that into? Well, we're going to split that into the change in common stock plus the change in retained earnings. Okay, so all we've done in this next step is we've split assets, liabilities, and equity into components. So assets into 4 components, liabilities into 2 components, and equity into 2 components. Okay, now let's move on to the next step. And what I need to do is clear out those other ones and bring our last step over to the left-hand side. And the next step is going to be, is breaking the property, plant, and equipment. So I've left the change in cash, the change in accounts receivable, the change in inventory the same. But now I'm going to break up this change in PP&E. So why does the PP&E balance change from the beginning of the year balance to the end of the year balance? It goes up with equipment purchases, and perhaps it goes down with equipment sales. So you can even consider this line item net equipment purchases. So equipment purchases minus equipment sales. You could consider that to be this line item here. But I'm simplifying to just be equipment purchases. That's how the PP&E balance goes up. It goes down when we record depreciation expense. So minus depreciation. In other words, the change in PP&E is equal to equipment purchases minus depreciation. So that's what I've done in this step. And I'm leaving accounts payable and debt the same, and the change in common stock the same. But now I'm going to break up retained earnings. How does retained earnings get from its beginning of the year balance to end of the year balance? Well, beginning retained earnings plus net income minus dividends equals ending retained earnings. So the change in retained earnings is equal to net income minus dividends. Okay, so this step I've split PP&E into its two components that you'll find in the PP&E T accounts, and retained earnings into its two components, net income, change in retained earnings into its two components, the change in net income and dividends. Okay, so that was that step. Okay, now let's move this over to the left-hand side and let's talk about the next step. The next step is moving this blue line. So we actually want to solve for the change in cash. Okay, so what is the change in cash equal to is what we want to know. So we're going to move the equals all the way up here. And the only thing we have to do now is subtract the change in accounts receivable, subtract the change in inventory, subtract equipment purchases, and add depreciation to each side of the equation. So you'll see this plus accounts receivable becomes a minus accounts receivable because we've moved it to the other side of the equals sign. And minus change in inventory, minus equipment purchases, plus depreciation. And so that's what we had to change in this step. But down here, these elements, they were already on this side of the equals sign. And so they remain the same, plus the change in accounts payable, plus the change in debt, plus change in common stock, plus net income, and minus dividends. Okay, so all I did in this step is move the equal sign up so that we are solving for the change in cash. Note that we're getting pretty close here because the cash flow statement is defined as the change in cash as explained by three different activities: operating activities, investing activities, and financing activities. So now we're solving for the change in cash as a function of the changes in other balance sheet accounts. Okay. All right, great. So now let's move to the next step. And the next step is to reorganize. Okay. So now we're saying the change in cash, and all we're doing is moving this net income up to the top. Okay. So I moved the net income up to the top. Then I'm moving the depreciation to be the next one, but I'm not changing the sign. All I'm doing is reorganizing the location of these items, but they're all still on the same side of the equals. Next, we'll subtract the change in accounts receivable, and we'll subtract the change in inventory. We'll add the change in accounts payable. We'll subtract equipment purchases. We'll add the change in debt. We'll add the change in common stock, and we'll subtract dividends. Okay, so from the left-hand side to the right-hand side, the only thing we've done is reorganized the ordering of each of these items. Okay, well, what's next? Well, next is we're actually done. So I'm highlighting here a purple section, and this purple section is actually the operating cash flow. So it's cash flow from operating activities. And you'll remember that this is actually the indirect method to arrive at operating cash flow. You start with net income, you add back depreciation because it's a non-cash expense. You subtract changes in operating assets, and you add changes in operating liabilities, okay? So this is the operating section of the cash flow statement, and this is the indirect method right here in this purple section. Okay, the next section, the green section, that's actually cash flow from investing activities. When we make equipment purchases, that is a cash outflow, so it shows up as a minus sign here. And so what the amount of equipment purchases that we make is a cash outflow, and we'll typically on the cash flow statement call this capital expenditures. Okay, that's the other word for this equipment purchases, is capital expenditures. And so that is, in a simplified balance sheet, that is equal to our investing activities. How much did you spend on equipment purchases? And remember, we treated this line item as equipment purchases minus equipment sales. So you could, if you wanted to break this out into minus equipment purchases plus equipment sales, because equipment purchases is a cash outflow, so it's a minus, and equipment sales is a cash inflow since it's proceeds from selling equipment. So if you wanted to split that out into two items, you could do that. Okay, and finally, we have our financing cash flows. So changes in the debt balance. So have you taken out new debt, in which case the debt balance would go up, it would be a cash inflow? Or have you paid back old debt balances, in which case the debt balance would go down and it would be a cash outflow? Have you taken new equity financing, in which case common stock would go up and it would be a cash inflow? Or have you paid back, have you repurchased common stock, in which case common stock would go down. It'd be a cash outflow. And then subtracting dividends, have you paid any dividends? And that's going to be a cash outflow. So it's got a minus sign. So there you go. We've derived the cash flow statement just simply starting with the idea that assets equals liabilities plus equity. Then we kind of expanded assets, liabilities, and equity to be a simplified balance sheet. We took the changes in all those accounts, the changes in assets equals the changes in liabilities plus equity. And then for certain accounts like PP&E and retained earnings, we had to split it up because PP&E goes up with equipment purchases and goes down with depreciation. So we had to split that up. And the retained earnings account goes up with net income and it goes down with dividends. So we split that up as well. And a little bit of rearranging, and before you know it, we had the cash flow statement. So that's it. That's a derivation of the cash flow statement. I won't go on any further. That's what I wanted to show you. And some of you might find it useful or interesting. Some of you might find that it went over your heads, and that's fine too. I just wanted to provide this as a resource because it certainly could be useful if you want a sort of a deeper understanding of how the financial statements are connected. Okay, that's it. I'll stop there. I'll see you next time. Bye-bye.